In this video clip, we're going to review question 10.11 on business combinations and with this subsequent liquidation of the company that sold their assets. So if you just want to take time to read through the question 10.11 before we continue with the question. Now, it's always good exam technique before you start answering a question to read the required. It helps you to know what you should look for in the question when reading the question, and then basically what we're working towards. So let's see, in the required there's an A and B. In A they ask us to prepare the acquisition analysis and the journal entries in the books of New Starfish Limited to record the acquisition of Tuna Limited. In the B part, we have to prepare the liquidation, liquidators' cash, and the shareholders' distribution ledger accounts in the records of Tuna Limited. So just from the required, we already got an idea that New Starfish Limited is the acquirer, and they've acquired Tuna Limited. We're not sure exactly yet what they've acquired, so we need to look at the question, but we know that after the acquisition, Tuna Limited went into liquidation. Okay, so if we read the question now, we see that on the 1st of July 2013, two companies, New Starfish and Tuna Limited, signed an agreement whereby the operations of Tuna Limited are to be taken over by New Starfish. So New Starfish is the acquirer, and the acquisition date was the 1st of July 2013. Acquisition date, of course, in terms of a business combination is very important because we work with fair values, valuing the assets or acquired or the liabilities assumed as part of the business combination. We have to value that at fair value, and therefore the actual date of the acquisition is quite important to help us to identify those fair values. Okay, then Tuna Limited is to liquidate after the transfer is complete, so it should be a voluntary liquidation. And then they give us the statement of financial positions of the two companies. Acquisition of Tuna Limited. What is being acquired? New Starfish is to acquire all the assets of Tuna Limited except for cash. The assets are recorded at fair value except for inventory, plant and equipment, and the shares in Sefton Limited. So we know that with a business combination, the assumption is made that the assets that are acquired and the liabilities that are assumed needs to be brought into the records of the acquirer based on fair value. So if the assets are not recorded at their fair value, then we have to make an adjustment to get them from the carrying amount, which is included in the financial statements, to the fair value. Okay, so you can think along where that adjustment needs to be made. Okay, then they tell us in exchange what the shareholders of Tuna Limited were to receive. So they got, maybe we can just make a new summary here. So this is regarding the consideration that is transferred as part of the business combination. So the A-class shareholders in Tuna Limited were to receive 1/7% debenture, 1 times 7% debenture in New Starfish, which is redeemable on the 1st of July 2015, for every share that was held in Tuna Limited. The fair value of each debenture is $3.50. Okay, the B class shareholders are to receive 2 shares in New Starfish for every 3 shares held. The fair value of these shares is $2.70 each, and the issue cost of these shares amount to $900. Okay, additionally, so that also forms part of the consideration, New Starfish also has to provide Tuna sufficient cash additional to that they've already held to enable Tuna Limited to pay their liabilities. So cash to pay liabilities. So we need to do some sort of calculation to see how much they need to settle their debts. The outstanding debentures are to be redeemed at a 10% premium. Annual leave entitlements outstanding at the 1st of July is $16,200. Expected liquidation cost, which is not realized, are $5,000, and costs associated with undertaking the acquisition amounted to $2,600. So some cost information that we also need to consider.